Hey, welcome back. So recently I bought some Lyft after they crashed on the earnings release and I wanted to share some ideas with you. A quick intro, this is the number 2 ride-hailing service provider in the US with a roughly 24% market share, sharing pretty much a duopoly with Uber and developing in Canada. The revenue growth has been very good in 2024, reaching around 5.8 billion, which is the equivalent of a roughly 31% increase, which is well above their 5-year average. But if you look into it, that's like a fifth of what Uber generates in North America, so there is quite a ton of market share that a challenger can get. After several years of slowly improving it and some cost savings on top of the growth, the company has finally reported a positive free cash flow, which is actually quite impressive. They managed to make 766 million in 2024, which is really good for a 5.5 billion market cap, placing them at a ratio of around 7. As a note, that's kind of what Uber can make in a quarter, but that's like a 170 billion market cap company. But sure, Uber is the number 1 globally and everyone knows them, but at the same time, shouldn't Lyft's potential be valued higher, especially after proving this kind of growth? The margin is very similar to what Uber has, by the way, a bit smaller but can vary from quarter to quarter. They used to pay pretty high stock-based compensation, a lot of which went into R&D, but now as they make more money, they aren't using the stock to pay for everything. The number of shares increased quite a bit since the IPO, but again, when you don't make money, you need to fund things somehow. As a note, due to the share structure, the two founders own about 30% of the voting power. The rest is the normal Vanguard, Fidelity, BlackRock, UBS, so nothing unusual. I guess another reason why the SBC went down is due to them reducing the number of employees by about 40% since 2022. Obviously, the drivers aren't their employees and they most likely just subcontract all the marketing and stuff to agencies and go for a very light business model. And indeed, we see a lot less money go into general and administrative expenses and more into sales and marketing, which is kind of normal for a company that's developing. Financially, they are in an okay position when you account for the fact that they have 1.7 billion in short-term insurance reserves. This is more about the business model and it's not necessarily a liability. Another interesting thing is that since they don't pay the drivers instantly, they can have this thing known as a float income. Basically, when you have a constant 1-2 billion that you receive and have to pay later, you can put them in money market accounts or other short-term interest-generating assets. It may not sound like a lot, but in total, when you add all the cash equivalents and investments, this company makes like 160 million in interest now. As they grow, this can offset a cut in interest rates, so they should have some cash inflows coming on top of the operating profits. They barely have interest to pay, by the way, because there isn't a lot of debt. They also have 390 million in convertible notes which are current, so there should be some news about that pretty soon. Something very important that the market may have missed are the $500 million in buybacks that they announced, meaning around the 10% total yield. Despite it, the stock still fell significantly on the day of the release, and again, I think the market is focused maybe too much on the short-term guidance. Now, we don't know when or if they'll do it, it's an open agreement, but if they do this over 1-2 years, it's very similar to Nike or PayPal, placing them among the top on the planet, so quite a bit. Very recently, we saw the activist investor Bill Ackman actually buying about 2 billion worth of Uber. For some reason, I see this more in tabloids than actual news outlets. Anyway, long story short, he bought about 1% of the company and does the normal activist investor thing, like the past management's decisions were bad and we need to move in this direction or even replace the whole management team and stuff like that. Now, the impact, honestly, even before Lyft was expecting a price war with Uber, but it's too early to assume. I think it could be a risk for them, but especially for Uber's international competitors, because as I said before, it may be the number 1 globally, but locally, it's far from the number 1 in some cases with huge potential. Or they could even bring Uber back into fintech, or make it worse, or do nothing and eventually sell them, who knows. For now, it's an uncertainty, not necessarily a risk. By the way, recently, the CEO also talked about the future plans to bring fully autonomous robotaxis in the US, which could be pretty interesting. Even if it won't be something huge, it can be enough to get the market's attention, especially if they do some collab with Tesla and talk about AI, disruption and stuff like that. And at the same time, don't forget about the potential for a company like Amazon to buy them if they want to expand, which they do. If you think about it, Amazon or even Apple can really push a company like Lyft into probably even more than Uber is today, especially with fully autonomous cars. And don't forget that both are investing in that, and buying Lyft for 10, even 20 billion is quite meaningless for them. Now let's see a valuation. In a bad scenario with tougher competition and falling margins, let's say they stabilize at 400 million per year, which is well below what they just had. Keep the ratio at 7 to show no improvement in the market sentiment, and that's a 2.8 billion market cap. That's a price of 6.7, which isn't very far from the company's bottom. But if they keep issuing shares, it's actually worse because you have to divide the market cap into more and get a lower price. On the other hand, they can afford to pay significant dividends and buybacks, and they would also be well below the equity, so I don't know how sustainable this level can be in the long term. In a better scenario, let's say they keep growing, but due to the price war, they only reach 1 billion per year. Say the ratio is at 15, which isn't even much and should be okay given potential worries from the market, and that's a 15 billion market cap. That's a price of 35.9, meaning around a 160-70% profit. Add the potentially huge buybacks and even dividends, and this can easily be a 3x in such a scenario. And to get here, it's literally like 3 average years of revenue growth on a lower margin, not something impossible at all. And comparing them to Uber, Grab or other competition, it's not even such a high ratio. Now, in a better scenario, let's say they double the cash flow in half a decade, which is not amazing for a company in this stage, but it's okay given the competitive environment. So 1.5 billion on a ratio of let's say 25, which is again not insane, is a market cap of 37.5 billion. That's a price of 89.77, meaning a very impressive roughly 570% profit plus the potential from buybacks, which they can even ramp up. And again, this isn't even such an amazing scenario. It's a fair value if they manage to grow at less than what they did so far, so you can see why I bought it. If they put everything into buybacks during this time, or they do any better, or the market has more confidence in them, this can even be a 10-bagger. But obviously there is very high competitive pressure and at the same time potential for international expansion. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. So overall, I think we see a very strong company that offers a ton of potential. Even in the US, not talking about the potential expansion in Canada, there is a ton of market share that they can take from Uber. Plus, already making a ton of money, and even if that doesn't grow at all, it's enough for massive dividends and buybacks. Again, they just approved like 10% buybacks, which can really make a difference. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.